All right, we are talking about market maker sell and buy models in conjunction with the COT report, commercial hedging. So we've all seen a market maker buy model. We understand the idea of the sell side of the curve, creating a smart money reversal, which is where we expect to change state of delivery at a higher time frame key level. Okay. And then we see the sell side of the curve turn into the buy side of the curve. Everything that's paired sell orders here become reaccumulation longs on the buy side. That is the market maker sell model, buy model 101. We'll just call it market maker X model. That is the basic understanding of that. This happens on every fractal time frame. And what we want to focus on is creating a model and protocol so that you can actually study what you need to see when the hedge program changes the state of delivery. When you're actually looking for commercial traders to show you where they're likely going to change state of delivery. Okay, so this is the first diagram I want to show you, because inside of this, the COT is going to provide us their positions. We want to look to identify where the long positions are increasing on the sell side of the curve. Okay, so that's the first note you'd write in your notebook. We also want to see where the partial increases above a zero line would be. So if you haven't looked at the commitment of traders report, this is going to be something that we'll talk about today. So again, just to sum up what I just said, in this market maker X model, we're looking for efficient hedging program model inside of it. Okay, we're looking to time the accumulation of opposing orders to the current delivery program, and we want to see where the long accumulation through hedging under sell side delivery changes. Once we see that change in the program, then we expect it to provide expansion and direction of the accumulated positions. So when I was talking about the COT report, this is generally what you want to focus on. Like when you go to barchart.com and you actually look at the COT report, you're only looking at the red line, which is the commitment of traders. Commercial, longing, hedging on the sell side of the curve. This is what you want to see. That red line, you want to see them going long above the zero line while they're in a sell program, reaching an area of fair value. Okay, so I'll simplify that verbiage. When we get to a higher time frame key level, we want to see that prices already on the commercial hedging side creating a increase of longs above the zero line. Okay, once that happens, this entire sell model is already anticipated to create a smart money reversal. So we would identify long positions increasing on the sell side of the curve to confirm the hedge. And then once that happens, we want to see partial increases above the zero line. You see how we see this amazing leap, another amazing leap here. All this is happening where the smart money reversal is forming. That's where the majority of the actual longs pairing with sell side liquidity is happening. When we talk about interbank traders reaccumulating longs below old lows, this is where the fair value of price comes. So we're talking about price and time, fair value of price and time. We pair this with seasonal tendencies so that we can understand where the model can actually form. It's where the liquidity is. Okay, so if you pair this with the market maker buy model, this is everything put together. Do you see that? That makes sense now inside of a model, because this is just a diagram, the same price action. This is what you want to see. The sell side of the curve get to a point where they're at the key level. We expect to change state of delivery. Smart money is already hedging longs on the sell side. We expect this distribution to become reaccumulation here. Commercial longs hedging on the sell side of the curve. Everything has been allocated here below the sell side liquidity. Open interest increase on buy side of the curve. We're not going to talk about open interest much here because we're just focusing on the commercial hedging. So now let's go to the actual chart and look. You can see from a long standpoint, all of 2022, all of this selling happening, right? All going into 2023, and then we have an increase above zero. Do you see how we increase? It's going into 2023 right here. I want to highlight this because this is a study. We have to look in hindsight. I'm not claiming to talk about the current. I'm talking about this is a study. Okay, so this is 2023. Do you see how we are effectively already in a long commercial hedging long situation here, right? Now, what I want to focus on here is the seasonal tendency. If we already understand everything above here, right, was showing lots of longs, and then we see decreases in longs as the trend gets to its peak. Notice all of the pullbacks in 2022. All the pullbacks had sponsorship from the commercial long. If you understand how to trade intra-week reversals and if you understand the higher time frame, you can be a part of these longs with the seasonal tendency. What I want to highlight is March of 2022. Roughly March, April. It's not exact. It's not black and white. Sometimes it's 3, sometimes it's 4 months. You know, I would say in this instance here, we focus on when smart money is changing its state of delivery. Effectively here, right? Because you see smart money, I'll just say commercial hedgers, drop below and then rapidly increase here. This is the sponsorship after running sell side liquidity. Do you see that? This is a major shift in line with a seasonal tendency in March, right? Then what happens? We get to the top. Do you see a change in the commercial hedging program here? Do you see this rapid drop here, right? In line with all this. I'm not going to focus on it. Let's go all the way to June and just look at what happened here. Major drop. We run an old high and a major drop here. All along the 2022 was a sell model, but you could see that the commercial hedging lines here were showing you when they were actually rapidly dropping. Every time we get below 0, that's a good time to start taking profit because you just don't know if commercial hedgers are going to continue to decrease longs or if they're going to stay stagnant. So imagine this. They do a major drop here, right here, right? And then another drop here. We're above 0, and then they drop again. There was space to run liquidity. So you have to pair it with liquidity. This is a market maker sell model. Major change. Here we go. Summer. Another decrease. Look at this. This is insane, right? We have accumulation below a sell side liquidity pool and then a rapid push up. Right here, what is the tendency from basically October, usually September, October, all the way to January? We normally see rallies, but instead we got a, right here, we got a change of state of delivery going into August, September. Right here, we see a major increase in longs. They do a big pull, push up, and then a huge drop while smart money is increasing longs or commercial hedging traders. What's happening here? All of 2022 serving as a huge accumulation. So we get into 2023 and it's like the most insane bullish push up in the start of the year because all of 2022 is making higher lows of this commercial program. So this is the point of the study. It's not to say, oh, I can anticipate every single move. It's just to show that you can create a model every 3 to 4 months to basically position trade, basically create a bias in which direction you want to trade it. So for 3 to 4 months, you should be able to say, I'm going to trade in line with this direction. You can look at this and see it. We peaked out a strong start to the month right here, Judas swing, and then bang, by the end of March, all of April is just selling. So if you're looking at it from a 3 to 4 month standpoint, you should be able to kind of see the direction of the market using commercial hedging. So let's look at an example, because I don't want to spend too much time on last year. I just really want to highlight the uptrend in the commercial hedging. Let's look at what happens here now going into March. I'm sorry. Here's March. We expect a seasonal tendency to happen here, some kind of change, right? So with that being said, would you expect, we're pretty overbought on the commercial longs here. Would you expect a decrease or an increase? Based on what I've shown you in the previous year, if this increases, does that mean that they're going to keep going long here? Because they increased here and they went down. So what information would we want to see there? Let's just look at the chart all the way up to September, because this is a study. We're increasing in price action right now, and commercial hedging is decreasing. Okay, we go all the way into September. Major increase. Look at this. Look at this decreasing in longs. Now I want you to notice we are below zero. Okay, every time we get below zero, we've run an old high here. What does that mean? Usually, we've run an old monthly high. We've been bullish out the gate from March all the way to August here. Okay, and we've been decreasing longs, and now we're just peeking our way back above zero here, July. Here's a down candle. That's a fair value gap that should hold, right? We got a consolidation. We have a push back up into that fair value gap, right? There's a lot of information being shown here. We're seeing a increase in longs here. Commercials are going to be the liquidity providers, right? They're always going to take the other side of the market, but their positions are true, where the price is actually, where the actual bullishness and bearishness is actually formulating is based on where the net longs or shorts are. They are aggressively net short, but we've gotten below this level here, the 0 point. And now we've aggressively have pushed price up, overextended. If this was an RSI, it's been overextended for a long fucking time. So what I want to focus on would be the start of the year, right? I would look at the start of the year and I would be thinking about, okay, where can I expect them to peak out at the start of the year? If I see them run above this high here, and I see the change of state of delivery here, I can now pair that with a seasonal tendency, expecting price to essentially give me a change of state of delivery, right? Do I have that change of state of delivery as it stands right now? We are going into August here. We have a fair value gap that is essential to higher time frame continuation, correct? Mm-hmm. If they break this, right? If they break this, then essentially I will know when the hedging starts to decrease, because we're already increasing. Remember what happened here when we started going long and then it rapidly decreased? This will set up my model in line with the seasonal tendency to understand that, okay, now price action is lining up with the commercial hedging. So it's not that when they're selling, the market's buying. It's understanding the actual cross and when price action is supporting what the commercial hedging traders have been doing. They've been decreasing this entire time while they've been going bullish. You can't just call a top, oh, they're decreasing, this is going to be the top right here. You can't do that, right? But what you can do is watch when they finally get to an oversold area, they give one attempt of price, showing that it wants to go that long. Then they go ahead and pull down, run the low, and come back above this. Now we're overextended. We're above an old high. So we have a multiple confluences now. Now we can build a narrative around this. This is the last price leg to run this high. So here we are in August. What we want to see is, does this fair value gap indeed hold price? And if this is optimal trade entry to continuation long here, right? This is what we would expect order flow to prove. If order flow does not prove this to actually continue trading long, and the COT report starts to decrease longs here, then we're going to know really quick. So this is the line that I drew. This line is subjective, right? It doesn't have to come to this line. As long as it's above this high, the moment they start dropping from this line, like this line can easily be here. You know, I don't have to, it doesn't have to be perfect. I just drew it subjectively, you know? So, okay, so here we are. If this is broken, right? And we're at the start of a seasonal tendency, and I start to see a change in the state of delivery with the COT report, I can know that we're going to be selling just simply based off of that. So let's zoom in here and look at this. This is for anybody trying to understand. This is the first week of August. And this is, let's just start it here because this is the week where the week starts. Okay? Monday, Tuesday, Wednesday, Thursday. We have a fair value gap left behind. This is a higher low. This candle runs down, breaking this right here. This is the shift, and to me, this is the break. Getting a candle body to actually close below this fair value gap. We have a change in state of delivery, right? CSD. And remember what we started this entire thing on. It's a market maker buy model, right? In a sense, we're now looking at a smart money reversal potentially forming above an old monthly high, which is here, right? If we get below this, it's gonna aggressively run that low, right? This is low resistance, and if you look at what's happening in the hedging program, we're still going net long. So I need to see proof of this, right? I need to see proof. So here's what I would do. This is now a Monday. This is a new start of the week. Where is your draw on liquidity for a Tuesday? You have a structure shift and a break. It's Monday, and you have low resistance liquidity. And on top of that, if you match it together with this, we have an increase in longs, but our structure is against the hedging program. So all it would take is a decrease in longs for the hedging program to prove us to be going short. This is the first week of the month, and they're already in a sell mode. So where's the next draw on liquidity? If you are in a buy model, like you said, nobody, where would they be reaching for the next day?
Basically, I would look for internal liquidity,
Correct.
taken external.
Correct. So let's go down to the 1 hour chart. That's previous week's price action. I've already done it. Okay, let's just go ahead and put midnight price. So here's Thursday. Okay, I'm looking for an internal run on Friday. 9 in the morning, runs right into it. Internal run right here. Do you see that? Comes in, what is this price level? 15,583.50. This is to me enough of a run on previous day high to go into an entire sell model. But it needs to prove itself. Okay, that's indecisive. 11 o'clock, pulling back up. All right. Oh, I love this because this is what happens when we get onto the charts, right? So now you effectively have a pretty strong bullish Friday. In order for me to even consider any sort of selling, because like you said, nobody, we're still in a buy program, I would need to see them change state of delivery. And this is actually in line with my PM reversal model that I just released. So like I would be very interested to see. Okay, that's a change state of delivery. Can we get a retest? No, just a full drop down. So we'll see the week close. So what happened there, nobody? Friday reached in for that fair value gap and closed down. Monday has pulled back up. So essentially, we still have no change in our COT report. So for the sake of what we're studying here, we're studying the COT hedging program. I don't want to engage until I see a change, a decrease in loves. So how long is it going to take for the hedging program to show a change in direction while price action is literally dropping? Okay, let's go ahead and go to the next. This is Monday, Tuesday, Wednesday, Thursday, Friday. Still no change. And look at what's happening here. The market is literally dropping. What's going on? Why aren't we seeing a drop in the commercial hedging program? Why aren't we seeing that? Look. You ready for this? Monday. Where's the draw on liquidity? So if this is a change in state of delivery to reach for internal liquidity, Previous day high would be our drawn liquidity, and the order flow is effectively bearish right now. And we have a inverted fair value gap, right? So what would I want to see going into Tuesday? I will want to see them run previous day high, and I would like to start seeing this effectively after Tuesday start dropping, right? I'm just going to go to the next day. That's Tuesday. Okay, now we've sat out Monday and Tuesday. We have a sharp drop in the hedging program. Now everything we talked about can finally come into fruition. Like, we're below zero. We've already increased longs. We've already seen them run this old monthly high. That's what this black line is. We've already seen them shift, break, and now run, shallow run on this liquidity. We haven't seen them aggressively run this liquidity. And because of that, we still have an opportunity to engage in the market. The draw on liquidity is below these lows, okay? The hedging program is effectively here. We have a market maker sell model in play, okay? With a smart money reversal, we have this level here as a redistribution. This is an accumulation level. Or if you wanted to make it into a smaller market maker sell model, all of this can be the model from low, accumulation, manipulation. We should see distribution. You understand what I said there? This could all be your accumulation while smart money is hedging longs, right? This could be your smart money reversal, which is now we expect the distribution. So we have all the information we want to see based on everything that I showed you over here. The only difference is that we're looking at an inversion chart. Okay? That's it. Smart money should now be what? Getting below the zero line, making lower lows and lower highs. We have the price reaching its fair value point above an old monthly high. So now we should see it starting to distribute. It's as simple as that. And I'm showing you how even when it looks like you're late to the move, like we've been talking about the selling since up here. Don't worry out on all of this because we didn't have the proof with the COT report. Now you have the proof. So where would you expect, where would your setup lie? Where's the model? Because that's what I wanted to study here with you all. Okay, let's go down to the 1 hour chart. Okay, this is midnight price. Okay, this is the draw on liquidity. Here's your weekly open price. We've already made our high. We are looking for shorts based on commercial hedging being here. Move this out of the way. And let's just focus on price action. Okay, where am I expecting the high of the day to form? I'll give you previous day's high, previous day's low. Okay, I see a redistribution here, so I'm going to draw it from here. Because internal to external is always where I focus on for my dealing range. This is coming in at about 190, 50% is coming in at about 166. We have an order block and another order block below that. I like this. This seems like a general level where I would expect price to want to reach for. And I don't want it to break 62%, and I don't want it to come. This is where I would draw it from. Probably even lower, like that. Focusing on this order block, because that's the proposal block, right? Order block below the order block. Now, I'm just looking for my classic continuation sell setup, which is a run on Asia high, or it could be a run on London high. This is an indice. Okay, so we have London. Okay, and I think we can go to the 15-minute time frame. This is for short-term trading. That's what this is about, short-term trading. So now here we are at 3:30 in the morning, right here. London's aggressively pushing up, right? And we've hit our point of interest at 4:30 in the morning. Most of you aren't trading London, right? I'm assuming most of you aren't trading London. But this is effectively already given, quote unquote, the high of the day likely. 5 in the morning, change in state of delivery, order block formation, 5:15, 5:30, 5:45. Look at this program. Here we are. Let's just fast forward to stock market open. Why did the market move so much before stock market open? You know, this is where it's like, when do I know when to trade London or not? This is the key level. It doesn't matter if it's true day or not. This is where it needed to go. And this is what's happening. Now you're waiting for what? Like, what could you possibly see here? You know what I mean? Like, this is where I feel like a lot of the frustration, and I have been through this so much, where I'm like, I'm gonna wait for stock market open, and then they go and do this shit at nighttime. Fear not. Okay? They will always retest London's high. Where is the draw on liquidity right now? 15 minutes before stock market opens. They've ran previous day low. We're starting the stock market at a discount. This is setting up a wonderful buy at stock market open, or you can wait for the short in line with the COT report. This is where you have to choose a side. I don't want you to be thinking like, as a intraday scalper, this is a short-term trading OSOK model for people who are trying to trade with the COT report. We're looking for sells. I want you to look at OTE from this high to this low, okay? I want you to look at that. Can you do that? Can you be disciplined enough to focus on the dealing range at play? Okay, 50% is right by these low resistance liquidities, but I want to see them take out these two highs and come into this fair value gap that's in line with the inverted fair value gap. To me, that's the golden zone. Okay, so check it out. 9:30. Aggressive run on stops and a push up. Somebody's already in a buy, right? 9:45. 10 o'clock. Insane, right? I mean, how could you beat that? What do you do in a situation like that? How comfortable are you to sell? Are any of you comfortable selling that? I'm not, right? I want to see them reject this level. Okay? I don't have enough proof. All right, now we have a swing high. I like that. I like that we have a swing high. It's still only 10:30 in the morning, fam. Like, you don't need to freak out. All right, 10:45. What's happening here? We have an accumulation above short-term highs after retesting London's sell model. Okay, what do I need to see to sell this? I need to see a confirmed change in state of delivery. Still, no change in state of delivery. I need to see them get below this low here. So at this point, is this looking like a AM setup or a PM setup? Remember, this is OSOK trading. You can enter there and put your stop above the high and walk away. But if you want to get in like a day trader and hold it like a short-term trader, you have no confirmation other than that it's OTE. So here's the stance. Take a position as an OSOK trader, put your stop right here. Okay?
Chris, I got a question. Why not to look for the about 9-hour liquidity above the wick of the previous day? This would be for me.
Here?
Yeah.
Are you asking why I'm not looking for it to break this high?
Yes, and the liquidity above the wick of the 9-hour of the last day.
Because the COT hedging program has already shown a sharp decrease in longs. They're effectively going into a sell model already. And we are in a higher time frame sell model, and we've already came to the high of the week based on the COT program. Remember, the COT program was net long all through this selling on the daily. We waited for Monday to give us a big sharp shoot up. Tuesday engulfed all of Monday's price action and consolidated. We do not need to come back up here based on the COT report. And that's why what we're seeing here is a accumulation. This is the short-term trade here for 272 points for the week. This is where you should be entering. And how long can you hold it? I'm going to just say to where we are talking about. This is your standard 2 negative deviations or 4 deviations. This is generally where you're going to get. So what I'm telling you is enter one trade here at the OSOK and then wait for the PM to show an actual clean setup with a fair value gap. Because this is not easy. This is not an easy setup. You have to submit to time. So let's see what they give you. Here's the PM. PM always does this shit too, man. It never fucking fails. Like they always do this. So here we are, 1 o'clock. They're gonna reverse and come back internal. I made a whole entire model on this. They've already ran the low. They get above that high and retest. It's gonna push back up. Okay, see, now they've pushed back up. Is that not from this high now to this low? Is that not OTE almost? Wait for them to get to OTE. Very sharp push up. Yeah, so that's your setup inside of this fair value gap. You can see that they're proving, right? It's not me just talking shit. Like we already knew we were bearish to start today. The only reason why we had this bullshit is because London made the high. New York session pushed up at the stock market open to London's high, where they left fair value behind. They accumulated in the AM. They displaced in the lunch hour. So now we're pulling back in the PM to make a continuation setup. This is where you sell short again. And where's your stop loss? At the AM high. And then you just let it go. You hold the trade until terminus because you have no choice. And it might not hit it that day, you know, but you hold it. A lot of you futures prop firm traders, I can't talk to you about it because you can't do this, but this is a short-term trading model. Ideally, what? You don't want to see them break that fair value gap. Why? Why don't you want to see them break this fair value gap? Because it would disable the model. So this is where you want to see them fail. Okay? And stock market open. You don't want to see them break this. So 9:15, look at this change state of delivery already occurring. Stock market opens and aggressively runs away from that. Why? Why can you be confident? Because the COT report already told you we were going down. This whole entire thing has been about studying the market maker X model in line with the COT hedging report. Until we get to this terminus, and we see another change in state of delivery with the COT report, which you can't see on this lower time frame, we're holding these shorts. We're holding them. Okay, so now we're holding this. I didn't enter another position because we have 2 really good positions in a premium. Okay, we need to see another manufactured premium created. How would that go? Well, this is the AM trend. We would need to see them run this sell side liquidity, okay? And then you would need to see them pull back. That would give us a new dealing range. Okay, so this is 10 in the morning. Okay, we need to see them come back up and respect. Where's the premium array? There's only one here. There's only one premium array here. This is the only place you could take a re-entry, and it's why should you? You already caught the OSOK. You know what I mean? Like, don't be greedy. So here we are. What time is this? 12:15. Oh, this is setting up a wonderful PM reversal. Yo, if you haven't seen my ebook on this, I've literally got examples on this, but this is classic. Yeah, they tapped fair value gap, change state of delivery. Like, that's it. And flattened. Wonderful buy sell model created in this entire week based off of this was our indicator. We had the increase in net commercial net longs. We ran above that level here, this old level. We knew the seasonal tendency was coming in. We were coming in for the shift, and we're targeting this area below these lows. Do you see how that worked out? This is a study in hindsight of how you can create a model understanding how to use the COT hedging program. And all you have to do is what a buy model looks like. Okay. I'm going to review this again just so we can come back and have full circle. This market maker X model is to time the accumulation of opposing orders to the current delivery program. Long accumulations through hedging under sell side. So we want to see longs forming while they're selling from the higher time frame. You want to see the longs forming. Once you get to this key level here, okay, then and we'll invert it for the sake of the fact that we did a bearish model. Once you see that we've hit a key level here, you see how we hit a key level, we've ran this high here, we see that there's actual longs here. So we have to wait for them to start going short before we can actually engage in the model. And because of that, we end up missing this high, right? And we even missed a little bit of this high, right? But we got in here. Now, mind you, there's 20 trading days in a month, and this is all in August. If you're trying to be a short-term trader, okay, then you're not looking at how many days you trade. You're looking at, did I catch the swing of the month? Position trading, short-term trading, swing trading, they all have the same premise. As long as I catch a chunk of that move using the COT report, I'm happy. Could there have been indication for me to get short here? Yeah, but there was no indication in the hedging program. So you would have been basically using intraday narrative to prove you right. And do you notice how hard it was to get in the market over here? Okay, this is why I'm showing you in a study. Look at this week. It was not really easily, like all of this shorting happened in London. You know what I mean? Like we had a buy in New York. We had a buy in New York. We had a buy in New York. Like this isn't good market conditions, right? And notice while they're doing all this, they're increasing long still on the COT report. So it's really, really incredibly important that you identify yourself as a patient trader if you're going to trade this model. The market maker X model only works with the COT hedging if you have the patience to wait for there to be a sharp decline. We got the decline on Tuesday, on the 15th day of the month. So that means for 2 weeks, you are observing the market, waiting for your perfect strike, and then you get it on a Tuesday. You know after Tuesday they have the sharp drop. So once you have that understanding, it's very simple. Okay, it is actually, I can say it with certainty. After this Tuesday, and nobody, you asked a very good question. Why would you not expect them to go higher and take out the 9 o'clock in the morning, high from previous day? Because we had this sharp decrease in the program and the hedging on Tuesday. And I already saw London respect this PD array. And we focus on the PD arrays in the order of importance. If this took out the old high, created the change state of delivery, the rejection block, right? The order block, the breaker block is being respected, right? The mitigation block is being respected. What's next? We're at equilibrium. So now the sequence end starts again. Run on an old high, right? We want to see a rejection block or a higher resistance liquidity run, order block, fair value gap, breaker block, right? We don't get the breaker because it's a continuation setup. This is a higher probability setup because it's like ICT said. You want to see a drop 50% from the smart money reversal and then you want to see redistribution. This is effectively redistribution. We don't trade London, right? High and low, but we can get in line. In New York, we could take a sell, anticipating London's high not to be broken. And then we take our high probability short in the PM, knowing that this is actually giving us an external to internal pullback and sell side. Then you hold and submit to time. You make sure that the next day does not break this gap. That's algorithmic. It should not break that gap. It comes straight to the T. To the high of that gap, stock market opens straight down. You don't even need to trade that because you get a retest of the PM and then you get your terminus. 2 entries, 15 days, $8,000. 2 NQ on a 272 point run, which is about 1,100 ticks. $8,000. You trade 1 day. You hold it for 2 days. You make $8,000.